afternoon, traders, and welcome back. Starting with today's WTI, the oil prices dropped yesterday with the Brent falling below $70 per barrel for the first time since 2021. The market looks oversold, but the sentiment remains negative. OPEC Plus is concerned about the weak prices and potential oversupply in 2025. To stabilize the prices, they may need to adjust their policy. If they cancel the production cuts to squeeze out the non-OPEC producers, the prices could drop further. Even with the cuts, compliance may falter as lower prices pressure members to increase the production for revenue. Meanwhile, the U.S. drilling could slow down, and the WTI crude futures curve suggests limited supply growth in 2025 to 2026. The EIA forecast for U.S. oil production to grow by 420,000 barrels per day in 2025, slightly lower than last month's estimate. While OPEC's latest report also adjusted the demand forecasts slightly but remain more optimistic than other agencies, expecting global demand to rise by 2 million barrels per day this year at 1.74 billion barrels in 2025. OPEC's production fell in August largely due to shutdown in Libya. And then next, for the dollar index, on Wednesday, the US CPI report is the last major data point before the Fed September meeting. The market expects both headlines and the core CPI to increase by 0.2% month over month, which could bring the headlines annual rate down from 2.9% to 2.6%, while the core inflation stays at 3.2%. A potential risk is a rise in core service prices. This data isn't likely to change the Fed's plan for rate cuts. While Fed is expected to make a 25 basis point, there's a slim chance of a 50 basis point cut. Goldman Sachs notes that the latest employment reported wasn't strong enough to push the Fed towards a faster rate cuts, but wasn't weak enough to trigger a 50 basis point cut either. The market expectations are split between two scenarios: back-to-back 25 basis point cuts or a larger cut. While the recession fears remain low, there's not enough strong data to push interest rates higher. And last, for the gold, despite a rebound last week, the US dollar index is still trending downward. The weak non-farm data and the expectations from Fed rate cuts up to 100 basis points this year are driving this decline. While the 50 basis point cut in September is less likely, the market expects a larger cuts in the remaining FOMC meetings, which has fueled the gold prices. Tonight's US August CPI data could impact both the dollar and gold. Inflation has been cooling, with July's CPI at 2.9%, and the market expects to drop 2.6% in August. If the inflation is lower than expected, the Fed might cut for 50 points, weakening the dollar and boosting the gold. If the inflation rebounds, it could slow rate cuts and pressure gold. The gold's outlook remains bullish as the dollar weakened. A continued drop in inflation could push gold to new high, while the price inflation increase might challenge the bullish trend. And that is all for today. Thank you for watching.